Joining us with this week's Ag Week Market Extra is Vince Boddicker. I want to start off with yield prospects. USDA gave us record corn and soybean yields in the August 10th report. Do you think those yields are out there, Vince, first?
From what we've seen so far, looking at the crop tours, it looks like it's there. The different people that I've talked to in the various states and listened to, there's areas where you're not as good as you'd like to be, but I think every state has some areas where there's record yields. In this part of South Dakota and that east central, I think we're very good. We didn't have excess rains, but the combines will tell the real story, and I think a lot of it is dialed in already.
If we assume that big crops get bigger than in the September 10th report or the September report, do we get that confirmed by USDA?
We could. But you think of the 3 bushel an acre yield that they gave us in August, I would think it would be unlikely that at this point in time they do a lot more than that. I think they'll be more conservative from this point. And again, I would, in my own mind, think 49 on beans, maybe 178 on corn might be the top end versus thinking you go a lot higher.
So with the idea that we have maybe record crops out there or near record crops, how defensive do producers need to be?
Part of it depends on, do you have to sell at harvest or not? If you're in beans and you have to sell at harvest, I think you look for opportunities above $9 to $9.50 to make sales. Before that point, if you get breaks in prices on that November futures of $8.80 or lower, maybe you look at buying some call options in the mid-9s just in case a trade deal gets done. If it does, and you also get some compensation from the government, you're sitting in great shape, you have nothing to lose. If you're a producer that doesn't have to make any sales at harvest, you may want to be a bit more conservative, but you still need to worry about if we don't get a trade deal done in the next 2 or 3 months, this may get quite prolonged.
But there are a lot of producers that are right now not doing anything, aren't there?
Right, and I think a lot of that is because of fear and uncertainty. Like anything else, if you know what the odds are and what's happening, you can make a decision. But right now, look at it from the standpoint and the strategy that I just pointed out. Would you be better off that if you bought some call options down here, sold in that mid-9s someplace or lower 9s if they got there, and it went 50 cents higher and you missed it? Or are you worse off if you do nothing and it drops $1 and then you're forced to sell? And let's take the same scenario that you didn't do anything and you get the harvest time and you were counting on using a delayed pricing program or deferred pricing program. What if your elevator doesn't offer it? What if it's 40 or 50 cents a bushel, especially in this northern plains area where we're pretty much going to the west coast and we're landlocked because of the Chinese situation?
Is that why the DP contracts have gotten to be so expensive, both for corn and beans?
I think so, and I haven't looked at any prices where they're at, but I'm guessing if I'm the facility manager, I have to realize that if a trade deal gets done, basis could narrow quickly, and the only way for those guys to cover themselves is to have a big upfront charge to do that.
Corn market, is there more upside potential there because of the supply and demand tug of war and that maybe demand might win out here?
I think demand will win out as we go over time. Yes, we have a big crop coming. We did last year. If we look at January, we were looking at a carryover of almost 2.5 billion bushels. Now it's just over 2. Predicting less than that next year. So I think we have some good opportunities next year. But I also think you have to be a bit defensive for next year's crop in case we get a 5 or 7 million acre increase if the soybean tariff keeps going. If you get 410 to 420, you may want to make some sales and have something on the books.
Yeah, the corn-soybean ratio is really widened out here, hasn't it?
It has. It has. And again, it'll come together again, but those are when you look for opportunities.
Part of the strength in the corn market, or the rebound in the corn market, has come on the heels of the wheat market, which has started to look like it's starting to turn over. Do you think we are putting a top in there?
In the wheat market, I think when you look at a couple of weeks ago, we had 2 days where you had sharply higher prices and closed near the lows of the day. That second day, I think, was an indication, even though it made new highs for the move, that we're probably done for now, unless we get other news. We're getting talks of rains out of Australia. Maybe the Russian crop is going to be better and do more exports than they thought. So I think you be defensive on wheat. Maybe not right here, but any kind of rally like we had late last week, I think you take advantage of it.
So if wheat is starting to become an anchor on both corn and soybeans, can corn really see much more of upside in that market? Short
term, I really don't think a lot more than mid-80s to around 90. I think you're going to be more of a sideways trade till you get into harvest, see what the actual yields are, see if demand holds up, which I think it will.
Let's switch over to the cattle market. We have been fairly range bound here, but certainly box beef prices, cash has been better than a lot of people had expected. But we have now this talk of this wall of cattle that still hasn't come here. So where do you see us going? If we get out of this range, what gets us out of it? And do we pop out of the top side of the trading range or the bottom side?
Well, like all the markets, psychology is still the leader. We can talk about the wall of cattle that we've seen for many months. It's coming through. When you look at April placements, we had nearly 800,000 head more on feed than a year ago. When we got to May, every month at that point starts dropping off. So I think by mid-September at the latest, we should be through the bigger numbers. We're chewing through them well. The packer would like to save money, but I think he's making enough and knowing if demand stays up, he's not going to be able to save a lot more. So I think your chance to the upside is better to the downside. But again, if you got October in that 114, 15 area where it's at and you need to make sales, cover yourself, you're making money, you may want to do it. If you can go into that late fourth quarter, early first quarter of next year, I think you may see the mid 120s or 130.
The funds still seem to really like being long in the cattle market.
They do. Nothing has changed them out of there. The technicals are there. It's still, they think, a bargain. I think they'll stay in there.
Hogs have had a nice rally here with trade hopes for both China and Mexico. But do you think that we should be doing some hedging? Do you need to be defensive here, or will this market continue to run, especially if we start to see progress on any of these talks?
Part of it, I think, depends on where your break-evens and what is your risk tolerance. I really believe that in early August, we put a major low in the hog market. Not sure we're going to run away. We may get in the $10 trading range and go up and down. When we look at the market, most of this week, it's been pretty good. I think we're all right.
Thanks, Vince, for joining us. Vince Boddicker with Farmers Trading Company. That's this week's Ag Week Market Extra.